Hello and welcome to Business Television India. You're watching Beyond the Bottom Line and I am Hiral Desai. Joining us on the show is Anita Arjundas, the Managing Director of Mahindra Lifespaces. Welcome to the show, Anita. To start off with, firstly, if you talk of the real estate sector as a whole, constant ups and downs is something that we've always seen. There's always been turbulence as well. If you have to compare the last 3 years, that's probably between FY16 to FY18, how would you compare that to the period that we saw between FY13 and 15?
Well, fundamental nature of this industry is it is cyclical in nature, and so you will have moments of highs and moments of lows. That's kind of a given across the world in terms of real estate as an asset. But I think the last few years have definitely been interesting times in terms of the way the industry has shaped up and seen a lot happening to it, primarily because there's been a lot of significant regulatory shifts that have been taking place. So whether it was demonetization or whether it was GST coming in or whether it was RERA coming in, the insolvency and bankruptcy codes, I think the last 3-4 years has actually seen a lot of flux in terms of a shift towards an industry that will get more and more organized and more regulated from a perspective of consumer rights and from a perspective of ensuring that deliveries are done on time. While this means the short-term play out in terms of a lot of turmoil,
right,
a lot of confusion, a lot of constant upheaval, but I think from a long-term perspective it actually would play out to be good for consumers, good for investors and good for the industry as a whole. It is in a sense a sign of a maturing industry, but it comes with its fair share of problems that you will have in the short term.
Right. So yes, there will be teething problems as well to the kind of governance that we are getting over there. But everything said and done, what have been the key challenges that you have faced so far in terms of the sector?
Well, if you look at it from a demand perspective, and I think for a moment if I leave the whole regulation piece aside and just look at demand, I think the biggest challenge really has been that the industry had kind of scaled up to very significant inventory levels over a period of, say, between 2010 to 2015. And that was largely driven by real estate as an asset class being pursued by a lot of investors. And I'm talking about retail investors,
right,
not necessarily FDI. Prices depreciating, ticket sizes going up, affordability becoming an issue. But a lot of projects, supply was created. And over a period of time, demand started shrinking because prices remained stagnant. So the investor actually got out of real estate very significantly. And what was left was the end user. In a way, if you look at numbers, and I know there are different numbers thrown around, but one of the statistics out there is that the industry size in, say, 2013 for the top 8 cities was about 360,000 units a year. And that number today is 220,000 units a year. So you're looking at an industry which has actually lost 140,000 units of demand that existed about 5 years back. And that to me has been the most significant factor that the industry has been dealing with. We've kind of moved from a seller-led industry to a buyer-led industry. People have been forced to relook at the way they sell, the way they market, the way they look at pricing, the way they look at product. I think it's a fundamental change in the way all of us have been doing business versus the past.
So right now for Mahindra Lifespaces as well, where does the inventory stand right now, and how much time do you think you will take to liquidate that kind of inventory?
So if I had to look at total inventory that we have in terms of value basis, and I'm looking at inventory which is either launched or not yet launched. So I'm just looking at the total basket of product that we have in either the ongoing or the forthcoming projects. That's about 5,000 crores worth of inventory, out of which 3,000 is in the projects that have already been launched in different stages of development, but 2,000 is not even launched. We're still waiting for approvals. So really, if I leave that 2,000 crores out, it's about 3,000 crores of sales. And today we've been doing about an average of around 600 to 700 crores of sales in these kind of existing projects. So depending on which project you're looking at, it could be a pan out of about 3 to 4 years that the existing inventory will get sold out. The new inventory, which is about 2,000 crores, is actually coming in from multiple new projects. So it's about 6 new projects that constitute the 2,000 crores. So I don't look at it as a sequential selling process. If they all get launched at the same time or in the same period, one could get over in 1 year itself, one could take 2 years, one could take 3 years, but that's the pan out that we have. So I would say we are we have inventory, say, for the next 3 years of sales at current run rates. But the idea is to be able to actually augment the portfolio and be able to get more into our kitty, because we've completed many projects in the last 3-4 years. We need to now add somewhat. I mean, we had a peak of about 15 projects running till about a year and a half back. Today we've completed at least 4 of them, and we are down to 11. We will be down to 9 in the next 6 months. So we obviously need to augment that and at any point in time have at least 20-25 projects running. So we definitely look at a focus on ongoing projects to accelerate sales, B, get the launches going, and C, add new inventory so that we can grow the business as a whole.
So with all of that said and done, what's the kind of land bank that you have right now? Because to create that inventory, the first step that a company will need to take is to keep creating that kind of a land bank. Where does it stand right now? And how fast do you think as a company that you want to create a land bank?
So at this point in time, we honestly don't have a land bank. We prefer to operate in a model where we buy land, quickly put it into production by converting it into approvals, launching it, completing it, delivering it, and moving on. It is a very manufacturing cycle orientation that we have to the business. If I look at land bank, therefore, it just sits in the World City in Chennai, where we have about 9 million square feet of residential development that is yet to be converted into product. But otherwise, across the country, it is that 2,000 crores of launches that I spoke to you about, which is pending, and the 3,000 crores of ongoing sales.
But do you think any plans where you would want to create a land bank?
So I wouldn't call it a land bank. I would just say we would want to create a portfolio of new projects that will quickly go into development and production.
So you do not want to sit on empty land, but you want to pick up land wherever you think a project is something that you could start
and put it straight.
Exactly.
Yeah, so we currently are working on a few deals. I mean, we have about 4 land parcels that are in various stages of MOUs. That would add up together to about 2 to 3 million square feet that would come onto the table. So the idea is to get that in the near future, but get that immediately into the approval process and launch process, but simultaneously work on newer deal pipelines so that we can add more to the organization.
With the kind of inventory that everyone sits on with as well, and you have RERA that is coming in. Yes, your working capital is blocked somewhere a little bit in terms of the inventory that you have. Do you think that even RERA is posing challenges for real estate developers, mainly in terms of cash flow?
So I think it would depend on what people's business model has been. If some of the developers have kind of been focused only on launching projects and not necessarily taking them into the execution process, or they launched without approvals because it was allowed and then are now pursuing approvals, they're obviously constrained by the fact that they cannot collect more from customers until they actually start executing, until they register agreements, which they can't do until they are RERA registered. So for such developers, there would be an impact on cash flows because they've been used to selling on plan before starting work and say collecting a significant amount up front and then using that money to build. Today they kind of have to build, raise the demand, collect, and so this cash need cycle changes. In our case, because we were very particular that we would launch only with approvals, what was happening for us is we were getting our approvals in place, we were launching a project, within a month or 60 days we were starting construction on the same project because we had all our approvals. So the cycle has been maintained. When I go back and look at all our projects and look at the 70% that we are keeping in the bank account, which is going towards construction, we don't see a cash trapped situation because money is just sitting there locked and we're not able to take it out. Whatever is there is going to service construction. And so it's not that a significant amount of cash is trapped which we are not able to take out.
With all of this, earlier developers were able to complete any project with probably 50% of the sales proceeds. With RERA coming in, do you think that has come down? And if yes, even for a Mahindra Lifespace, from a 50%, do you think probably, because when we talk to analysts as well, they are of the opinion that probably that's come down to levels of around 20, 25%, 30%, that's the range now. Do you think that also poses a threat?
Well, it's actually a function of what the project profitability is at the end of the day. I mean, at what stage of break even do you need to reach to be able to ensure that your cash flows from customers takes care of construction is honestly a function of what that project cost structure is. If I'm sitting in a city like Bombay and I have say 50% of my realizable value as land, which I'm kind of able to take out in that 30%, construction would be covered by about 25-30%.
Well, affordable housing is something what the government is pushing on. Mahindra Lifespaces is also going pretty big on affordable housing. At this stage in time, what percentage of your revenues come from affordable housing as compared to premium and luxury?
So we started on this journey in 2014 and we decided to get into the low-cost housing, affordable housing space under the brand name Happiness. So it is Happiness by Mahindra Lifespaces, which is our affordable housing brand. And I know there are multiple definitions all over the place on what constitutes affordable housing. The segment that we focused on is sub 25 lakhs. So we've had homes which are typically between 10 and 25 lakhs. And the most recent launch that we had in Palghar last month is actually starting at 7 lakhs and going up to about 20-21 lakhs. Percentage to total business is still small today. So if I had to look at sales numbers, affordable would constitute about 10% of sales. It would be about 10% of revenues when I look at the total mix. If I looked at only the residential business, then it would be maybe 15% of the residential sales, because I'm not counting the World City business coming in. Over a period of time, that quantum of that number will significantly go up. But in terms of percentage, I still don't see it going above, say, 25% of the mix, because we expect the mid-end premium to also grow significantly from a quantum perspective.
Right. So with that,
and also I guess you need to realize that for every one affordable housing unit I sell, or for every one premium unit I sell, I have to sell multiple affordable housing units to come to the same value.
Right. And with that, the next question I was coming to was in terms of the margin profile. Affordable housing, yes, with the kind of price points that you have, is a low margin, product. Whereas your premium luxury is way higher. Number one, what's the kind of differential between the two? And do you think with you increasing your affordable housing, there could be some bit of a stress coming on the margin profile, at least in the initial period till the time it stabilizes?
So I would say even for the mid-end premium, margins today are not where they used to be. I mean, people would typically talk about anywhere between 30 to 40% as acceptable margins in mid-end premium. I think most people are today seeing a 25 to 30% as margins in the mid-end premium segment itself. Affordable was seen as a 15 to 20% kind of margins. In my view, we should be able to settle at a 20% margin on the affordable housing, with the mid-end premium being at 30%. So really the delta play then is a function of how much volumes can you get going and what speed you can get going, because if you're working with low-rise structures, faster implementation, hopefully strong support coming from the government in terms of the way they're looking at the whole single window approvals for affordable housing, etc. You start adding all of that, and if you can turn the same amount of money twice over in the same period of time in affordable housing, then even if the margins are smaller, volumes and speed
automatically
will at least help you have better returns over time.
Right. So overall, around 20% is what you're looking at, affordable, and 30 in the case of premium as well. But this will be something that will be maintained over time. So
even if I look at our current experience, I mean, we've had Happiness in Avadi in Chennai, we've had it in Boisar in Mumbai, and we have a third launch in Palghar. Numbers have varied, but I would just say that yes, we have kind of been able to maybe stay at least in the 15 to 18% range and not necessarily be way down as people were expecting. So for early first stage projects, the experience has been overall good in terms of being able to hit a certain number that we were looking at. Today we've delivered about 1,200 units across the first two projects. Between the three projects, we are close to about 2,000 units sold. So it's been an interesting 3 years of learning, and we're looking forward to scaling up the business.
Right. And again, what's the current, projects that are probably ongoing or in development stage in terms of where affordable housing goes?
So we have the three projects. The Happiness in Avadi, which is The first phase of 600 units is completed and handed over. We have the second and third phase of about 200 odd units which are currently being built out. And then finally we'll have the last phase, which is the fourth and fifth phase, which will come in. So between all of them put together about 1200 units in Avdi. We've sold about 8 to 900. In Boisar we have about the three phases that are ongoing. We have about 750 units. We've sold about 720. We just have 30 units to go. But the last phase has just been launched. That's about 200 units. So there's 950 units there, 1200 here, 2150. And we have about 1800 units in Palghar. So that'll be about 4,000 in all. Close to 2,000 sold.
Right. Now, in terms of geographies as well, current status, where are you seeing demand picking up? Because there have been bouts that currently everyone's talking of Bangalore. That's the space what's picking up. Pune is something that's picking up because again of the IT parks, etc. For Mahindra Lifespace, which are the regions that you are going to look to construct in now?
So our focus has always been on the salaried employee largely, and therefore we like to choose markets which are where you have a lot of job creation happening. So whether you look at Bangalore, whether you look at Pune or Hyderabad, these are markets, and Mumbai of course, and these are markets where there is regular job creation happening, either in terms of IT or in terms of services or in terms of manufacturing. These are markets therefore which are priority markets for us, have always been and will continue to be. So if I had to prioritize, I would say Mumbai, Pune, Bangalore as priority one markets, where we would at any point in time at least like to see 7 to 10 projects running in each of these cities. And then you come down to a Hyderabad and a national capital region, where at any point in time we would like to see 3-4 projects running. Chennai, we will restrict ourselves to being within the World City. Jaipur, we haven't launched the residential, but again when we launch the residential, it will be within the World City.
It will be within the World City. And World City also as a part of your revenues, how much contribution do you think comes from there? Because I think you do follow a leasing model there as well.
But it's a 99-year lease, so it's as good as a sale.
It's more of a Dubai kind of a market then?
No,
because I think Dubai usually, that's the model that they follow, that even if you buy an apartment, 99 years is the lease time, and from the 100th year, you have to, renew your leases there.
Well, in the World Cities, we're talking about service land sale to industrial customers, and there it is a 99-year lease. The Dubai model that you're referring to is there even in India. Noida has a lot of 99-year leases for residential. Jaipur has a lot of 99-year leases for residential. A lot of some of the NCR markets again have 99-year leases. So the residential part I'm not really looking at in terms of it being a 99-year lease model, but the industrial is 99-year lease, treated as a sale pretty much in terms of accounting. So therefore, if I had to look at World City contribution to top line today, it's about 20% of top line, and a little higher in terms of contribution to bottom line. We see that number being maintained over the next few years.
So that will stay the way it is. With that as well, you've been doing a lot of strategic efforts to reduce your capital intensity. You've been roping in a lot of marquee partners. You have HDFC as well, which has come in. Do you think that now the next need for you is going to be, portfolio augmentation then?
Yes, I think we've had, yes, you're right. I mean, we've had the privilege of having very good partners with whom we share a great relationship. There's been the Standard Chartered Real Estate arm, which was the first investment we did together, where we committed capital for premium residential. Then we had HDFC coming in for the affordable housing. We've had IFC coming in for the industrial clusters. So we've kind of got each of the three business verticals and segments. And you've got
the right partners.
We've got the right partners for each of these. I mean, different profiles of partners, but each one very interested in each of these spaces and coming in with the right mindset in terms of the number of years they want to stay invested for each of these segments. So I think it's a good fit that we are comfortable with. And so from a capital perspective, yes, I would say in the last 3 to 4 years, between all of these relationships and the rights issue, we've tied up close to 3,000 crores in terms of access to capital. Obviously that capital which is committed needs to now get into investment mode.
So if you talk about financials as well right now, we've seen a lot of ups and downs for Mahindra Life also. FY15 has been a spectacular year if we compare that. Almost 1,100 crores is the kind of revenues we've seen, more than 250 crores kind of a profit number, and if you see the at EBITDA operational level as well, number above 400 crores, wherein the other years have been somewhere in the range of 700 to 800 crores in revenues, your profits in the range of 900 to 100 crores, 90 to 100 crores. When do we see that same number at the peak level that we saw in FY15?
So first of all, I think I'd like to point out one thing both about 15 and second about the last couple of years in terms of just certain accounting aspects, and then we'll get to your question.
That's changed, yes.
So 15 was a year where we did sell a land parcel that we had in Baikula. So it was a joint development partnership. It was a joint venture partnership, actually a profit share partnership, which was a 25-year-old partnership. For various reasons. That deal never fructified. In fact, it went into arbitration for 20 years. We finally reconciled between the parties and agreed to sell it together. So you actually see a 325 crore contribution to top line and 15 having come in from there, and a very significant contribution to bottom line also having come in from there. So there was one aberration in that year in terms of the numbers. The second, if you look at the last couple of years, with the Indian accounting standards coming in, the bottom line is fine because it's a parallel to parallel reference, but the top line is actually not reflecting full top line consolidation, because under the India's requirements we don't consolidate all our subsidiaries. Wherever there are affirmative vote items, control rights with partners. So World City Chennai, World City Jaipur, the Stancy joint venture, none of these are consolidated.
Only the profit number is, I think, taken into consideration.
So if I had to actually do consolidation, then I would say we are, last year was about 1150 crores. The previous year again was around 1100 crores. That would be the range that we've been in. So 15 was 1100 with the 325 contribution, whereas subsequent years have been 1100 without that contribution. Profits, you're right. I mean, if I had to, since it's comparable, then even if I leave that particular year, we've kind of been in that 100 crore range in the last few years. And it's been a function of a couple of things. I think one, the point that I made, that margins have been under pressure in residential because of higher sales and marketing costs, because of prices not having moved. And we did buy our lands at the peak of the cycle. So some of that is kind of getting reflected in margin pressure. A part of it is also the fact that we have 6 launches which are scheduled. 3 of them were impacted by the High Court ban in Mumbai. We weren't able to launch. So there is a certain fixed cost amortization that hasn't happened over larger turnovers that we should have got coming in. So these two would have been contributory.
But if everything goes right, going ahead as well, in the next 2 to 3 years, do you think rates are expected to move up or down or stay stable? Number 2, if you have to see in terms of sales volumes as well, do you think that an uptrend is inevitable from here on?
I would agree to both. I mean, volumes will definitely pick up. We've already seen a pickup in the last few months, and they will continue to sustain because a certain amount of that supply overhang has been sorted out with no new launches for the last couple of years. The overhang that exists in certain markets, certain locations, certain categories will remain, and that needs to be sorted out differently. It doesn't mean the other products won't sell, because the locations that work, the price points that work, the sizes that work, there will be demand. So if we get in the right product at the right locations at the right prices, I would see demand improving. Prices, I wouldn't say will go back to the heady days of some double-digit kind of growth rate per annum, etc. But it would be more moderated. But you definitely would see a 4 to 5% price increase coming in per annum back into the market.
But that will be pretty much linked the way inflation's moving as well. And very lastly, if you see the debt to equity as well, we've seen a major downtick that's come in on the debt picture. FY17 was somewhere around 0.38. Number one, what's the kind of model that you're looking at? Because you're not investing a lot in terms of heavy land parcels like the way, Land Bank or the other developers are doing. Do you think Mahindra Lifespaces is a company which wants to remain completely debt-free? And if yes, any timelines do you have for that?
I wouldn't say remaining debt-free is a goal or a target or a virtue. I think it's important to have a certain amount of debt to equity, primarily to get your entire cost of capital
Correct.
to work efficiently. So from our perspective, I would say we've gone up to a peak of 1.05.
Correct.
We've come as low as, we've been 0.
0 as well.
We're currently in the 0.3, 0.4 range. I guess it's more important to look at how are you able to service interest and how are you able to service debt repayment rather than, choosing one specific number of whether I'll be at 0.5 or 0.7 or 0.1. We're quite comfortable being in that 0.5 to 0.8 kind of range of debt as a number which we can easily service in terms of interest cover and in terms of debt cover.
Thanks a lot, Anita. Thank you for joining us on the show and sharing all the details. So that was the management of Mahindra Lifespace, clearly giving us their launch pipeline as well as the growth story for the next 3 to 5 years. That's all that we have on this edition of Beyond the Bottom Line. Thanks for watching.